jukebox hero. He took one guitar. Jukebox hero. Jukebox hero. He'll come alive tonight. In a town without a name, in a heavy downpour, thought he passed his own shadow by the backstage door, like a trip through the past. To that day in the rain, and that one guitar made his whole life change. Now he needs to keep it rocking. He just can't stop. Gotta keep on rocking. That boy has got to stay on top and be a jukebox hero. Got stars in his eyes. He's a jukebox hero. Got stars to think things over. I better read between the lines in case I need it when I'm older. Now this mountain I must climb feels like the world upon my shoulder. But through the clouds I see love shine. It keeps me warm as life grows colder. In my life there's been heartache and pain. I don't know.
I apologize for the delay. We had some technical difficulties, but we're going to get started and get back on track. Good afternoon and welcome. I am Dave Buches. I work for the Community Investment Department at the Federal Home Loan Bank of Pittsburgh, and I'll be the moderator for this afternoon's panel discussion. Unlike Dr. Eisenberg, I'm not going to run around the audience, so this is it. It's all you get. I have, yes, I do. Yeah, it didn't work out. I have been informed that this panel, for those of you who need to know, that is being webcast. So I also want to welcome those folks who, and apologize again for the delay, to those folks who are watching us, watching the webcast. And for those of you here, try not to do anything foolish because you'll end up on YouTube. I don't think it's any secret that partnerships are a key element to successful housing and community projects. The work we all do to create affordable housing and community development projects is very complex, requires a variety of resources, and typically no one organization has all the resources needed, whether it be money, technical capacity, what's needed to bring some of these projects to fruition at their immediate disposal. So creating partnerships to achieve your objectives is often needed. So this afternoon's panel, we want to talk about that partnering process, particularly as it involves local financial institutions who are typically key partners in the affordable housing and community development process. So our panel will discuss 3 examples of partnerships between local housing organizations and their financial institutions, which we're hoping will give you 3 different perspectives on how that relationship works. And here to discuss their particular partnerships are, starting at the far end, Ellie Fisher and Macy Kislinski. Ellie is the Assistant Director at the Oakland Planning and Development Corporation, a nonprofit neighborhood development organization located in the Oakland neighborhood in Pittsburgh. Macy is Vice President for Real Estate and Tax Credit Capital at PNC, and his office is in Pittsburgh. Our second partnership will be Becky Yago and Andy Haynes. Becky is Vice President for Real Estate Lending and Services at Dollar Bank, and her office is in Pittsburgh. And Andy is the Executive Vice President of S&A Homes, a for-profit housing developer located in State College, Pennsylvania. And then our last partnership we're going to talk about is Bill Hall and Molly Fukin. Bill is the Housing Programs Manager at Clarify. Clarify is a nonprofit financial literacy, financial counseling organization with offices in Philadelphia. And Molly is Vice President, Community Outreach Consultant with the Consumer Lending Group, Community Relations and Outreach for the Northeast region at Wells Fargo, and her office is also in Philadelphia. So each of the partners has been asked to talk about how their partnerships came together and how they've evolved and grown over time. And they will also discuss the factors that make their relationships work and then identify for you what they feel are some of the keys to a more successful partnership with your financial institution. When we are done, we're hoping that each of you have gained some new perspectives on your relationships with your banking partners. So let's get started. In the interest of time, I'm going to ask that as your questions come to mind, that you jot them down and hold them until all 3 partners have made their comments. For those of you watching the webcast, just a reminder that you can also ask questions by using the chat feature. And for the benefit of our webcast audience, I would ask that those of you who are here in the audience, if you do have a question, please make use of the microphones provided so that your questions can be heard by all. So let's begin with the Oakland PDC and PNC partnership. Ellie, I'm going to ask you to start, and let me just advance the slides to talk about that relationship, which kind of started, kind of grew out of a more traditional banking relationship.
Mm-hmm. Thanks, Dave. Good afternoon. Yeah, we've banked with PNC for longer than I've been at Oakland Planning, for 8 years now. And so we have a strong business banking relationship, and that means that we know our local branch manager, and I call her with anything, and then she always brings us the business banker, and they work very closely together to help us with the variety of our needs. So we have checking, savings, line of credit, a couple mortgages, that sort of thing there. And then we were able to evolve that into neighborhood partnership program funding, and that came through our relationship with the community development bank manager. And that is a state tax credit 6-year funding commitment. So that was really just incredible for us as an organization to have that partnership and that funding commitment to support us and to support the variety of work that we do. Part of that funding commitment, we ended up putting our business banker on our board of directors, and then that helped the personal relationships grow, as well as she was just able to bring all sorts of support and ideas and advice to everything that we were doing. So it's helpful for them to be sort of in the weeds with us and the details of how we even run the organization. And that was really welcomed as well. And then this fall, we submitted our first in recent history low-income housing tax credit application. And we worked with Macy on putting that application together and submitting their letter. And it's been invaluable just getting the advice of well, this is how it works, because we haven't done it in a while. We submitted as the developer, and we had consultants to help us write it, and all the partners that you need. But being our first time getting into that, we leaned heavily on everybody, and I think we will if we get those credits. So it's been, I don't know if you want to add anything, Macy.
Yeah, I think in general it's been a good relationship. It's one that clearly the bank has a lot of capacity that it can give, and it's required to give, quite frankly. And so, but it doesn't necessarily give it out to just anybody who asks for it. I mean, it has to be a quality organization that has a long-standing track record. That's what we're going to associate ourselves with for the most part, and to so as they grow, we grow, and it's a good business model, I think, in general. It's worked out so far, so good.
Mm-hmm. Yeah, I think one of the things that I see that really helps is that everybody at PNC and then the other banks that we work with as well, they all know each other and they all refer each other. So I can call one person and say, oh, I need help with, refinancing this mortgage. And they're going to put me right in touch with that person that I need to talk to, and that person's going to call me right away. They want the business, right? But it helps me do my job because they're providing those services that we really need.
Yeah, so it gets to navigating the bank. Which an institution the size of PNC is not small, and quite frankly, understanding where you need to go to get the services that you need becomes critically important. So, if you find yourself, trying to get into this process if you're a nonprofit, getting to the right person in the bank is critically important. And we sort of, I think that's right when it works out with an OPDC, for instance, and using the branch banking initially, and then it eventually leads to tax credit capital and community lending in between, really works well. And so we work together with tax credit capital and community lending. It's a partnership that we have internally, and we share that basically with OPDC, and they tap into that expertise. So where I can't lend support on certain things operationally, community development can, thus the NPP grant. But when community development can't provide tax credit equity or expertise on the low-income housing tax credit program, that's where I come in. So it's worked out really well.
Mentioned on the when we talked about what makes a relationship work, Macy, demonstrated mission-driven results. Talk a little bit more about how important or why that's important to PNC.
Yeah, I mean, if just the extreme opposite would be just formulated a nonprofit. We have a business model, but we haven't acted on it, and we have no track record, and that becomes somewhat problematic. I mean, we want to put these resources into place with an entity that's been in business for a period of time that you can track, that has and that track record has positive results, and they have good people on their board, good people working for the staff that are credible and do what they say that they're going to do. And I think when you have those pieces, especially in a community like Pittsburgh, which is a small town for the most part, and if you're not doing what you say, it's going to get out. And I say the same thing with the bank. If the bank's not being straightforward or providing good service, that's also going to give out. So that tension that's there is a good working tension, but it's very positive, I think, for the relationship in general. So, that track record, quality of staff, quality of mission really plays to all the things that the PNC wants to be involved with.
And Ellie, you mentioned about having a bank member on your board. I assume that's a PNC member. So what does that add to your relationship then by having them serving on your board?
She's able to bring resources that PNC has that I don't even think to ask for. So we'll be talking about whatever's going on, and she's like, "Oh, well, we can help with you with this and this way." We've had Dollar Bank members on our board as well, and both of them actually, it was great having both together at the same time because lots of mutual respect and the same stuff Macy was talking about, but also both can bring just these resources that I don't even think about. Or if I do think about it, I just call her up right away and she puts me in touch with whomever I need to speak with.
That's good. Now, when you think about, with all that said and done, in terms of the recommendations you would make to folks in the audience about, their relationships with the bank, what are some, and I know you mentioned some of the, as far as navigating around larger banks, obviously smaller banks may be a little bit easier to get to the right people, but what are some of the other keys for both of you in terms of having a successful relationship with your financial institution?
I think I think there's trust. We have to have trust. I think we have to trust that their OPDC is going to deliver on what they say they're going to deliver, and they have to trust that the bank is going to be there for them when they need us. More than just checking or business banking, but as they grow and their complexity and their approach to community development grows, we're going to be there with them. So.
I don't know how you'd actually do this, but one of the things that's made it work is there's a lot of long-standing relationships. Like the people that we've worked with have been there a long time, and so they know our history, and they have the relationships with the other people in the bank. For example, our branch manager, she's wonderful. She's been there a long time. Our business banker, he's turned over a bunch, but also the branch manager brings us a new person every time, and she sets us up with them, and they work out great because if there's turnover, we have that long-standing relationship that's also there to carry us through the turnover. So I don't know how you find the person that's been there a long time and it's going to stay in the future, but that's been another key to our relationship is just low turnover.
So thank you, Ellie and Macy. Next, we have SNA Homes and Dollar Bank partnership, which came together around a housing project called Federal Hill. So, Andy, why don't you give us a...
Thanks, Dave. Good afternoon, everybody. The project we worked on together was more of a bricks and sticks. It's called Federal Hill. It's in the central north side section of Pittsburgh, which is just north of downtown, just near the stadiums. And it was part of a larger redevelopment area called Federal North. We partnered with a local CDC called Central Northside Neighborhood Council to do the residential portion of the redevelopment plan. And what we did, the whole planning process started in about 1994. We applied for home ownership choice funds in the mid-2000s. I can't remember the exact date. And then we used the PHFA home ownership choice program, which provided funding for sale urban housing. We utilized some URA loans and grants, and then we also used conventional financing. We built the project in two phases. The first phase was 23 units. It started around 2009, which coincidentally was the height of the recession or the beginning of the recession. So our original lender, a bank that was interested, backed out on us at the last minute. We went around. This was a point where every bank in the country was not willing to lend for a for-sale residential project in an urban neighborhood with no market. So we went back to PHFA and said, would you be the construction lender? And then actually they were mulling over it, and Dollar Bank approached me. Becky said we would be interested in being the lender. And I kind of went down the path with PHFA already and said to Becky, I said, let me stay with PHFA on this phase just because they've committed to help. And so we developed 23 units of the first phase. They sold unbelievably quickly. It was probably the best-selling development SNA has ever had, and we're a suburban home builder across the state. The houses sold from anywhere from 145 to up to the high 200s in the first phase, and it just went amazingly well in a really poor time to sell houses. So we then proceeded to do the next phase, and I went back to Becky and I said, "This is your project as the construction lender," she was excellent to work with because Becky understands the whole process. Macy talked about navigating the bank system. I let that up to Becky. Becky understands how soft financing works. You know, one of the challenges when you're doing a for-sale development in an urban neighborhood and you've got sales prices of $145, but it costs $200,000 to build it, is some people just don't understand that. Even our guys, our VP, CFO, they kept saying, how are you going to do this? And I kept explaining the grant covers the difference between the sales price and the construction cost. And it takes a lot of explaining to do. And the last thing you want to have to do is take all that time and explain it to the bank. And Becky understood it from day one. Do you want to snap onto the photos of what it was before? So real quickly, it was about a 3-block area of blighted properties. The URA, the Urban Redevelopment Authority, worked with us on acquiring the properties through the threat of eminent domain, but they ended up purchasing most of the properties. And then this is what they look like now. It's a beautiful project. If you're ever in Pittsburgh, I suggest you go up. It's right on Federal Street. And we're now at 44 units. The last one was sold in 2013. They're reselling at 50% more than what they paid for. We had one house at the last phase that sold for $380,000. People had upgrades. It was just, frankly, just a great successful project. And the relationship worked because with Dollar, like I said earlier, Becky understands the nuances of soft financing. She has an incredible reputation in Pittsburgh. When I was looking for a lender, when I went and talked to the local CDCs or Pittsburgh Community Reinvestment Group, which is a coalition of CDCs, Becky's name was one of the first to come up. So when I think of a bank, I don't necessarily think of Dollar, I think of Becky.
Wow.
Yeah. Becky, Yago Bank.
They're changing the name of the bank. So Becky, so what about this deal made it attractive to you? But the pressure's not on.
Yeah.
So what about this deal? What about that made it was attractive to you from the bank standpoint?
There was a few things. In talking with Andy from the beginning, he knew that neighborhood. When we walked through the neighborhood, I knew the north side. I'm familiar that there's many other neighborhoods in there, but Andy knew every section of everything that was going on. This is nuisance bar that's getting ready to be closed. The community group's going to take that one over. There was a small convenience store that there was a lot of crime. They had cameras put up. So it wasn't just the housing piece of it. It was the whole neighborhood and all the socioeconomics that he understood. And then the other major comfort is when you're dealing with experience. We will only deal with experienced developers. The riskiest investment you can do is real estate, especially new construction, because as soon as you start the first shovel in the ground, there could be problems. And I don't know if in any other city, but in Pittsburgh, anytime there was a hole dug, that meant that everybody cleaned their garages out and threw everything in that hole. And, some of those things may have had gasoline or some type of fluid in there, and, laying in there for 30 years, have some environmental issues, and maybe it hit water and then it flooded or, spread throughout the whole area. So anyway, the reputation of S&A Homes and with Andy Haynes, they understand that there could be problems. There's a contingency in there, but that contingency doesn't always cover everything because you just don't know until you start breaking ground. We knew with their reputation that anything that they've ever started, they completed. That's a big problem. In real estate, what we do is we try to identify all the risks, and then we try to mitigate those risks. And that's what dealing with an experienced developer. Have they hit problems? You don't really know what your relationship is until you hit a problem, and then you see how they work it out with you. I think
you had mentioned the market situation as being a challenge. How was that resolved?
Well, there's always a balance with inventory with new housing because housing is a non-income producing asset. So when you structure a loan, it's interest only, and your loan only gets paid back if the units sell. And a lot of times the developers or the community groups, they'll say there's an economy of scale. I can save money by putting 20 up at once because of the economy of scale. And, that's always a balance because there is economy of scale, but there's also an overabundance of inventory because if it takes a while to absorb, then you have all the interest carry on that. You have all the carrying costs. If you hit winter, you have the heating costs, real estate taxes. So the balance is always there, and Andy understood that as well. He wasn't coming at us. We want to do 44 units at once because, we know the market's there. And I think it was a very smart mix of putting some affordable with some higher end. For one, that makes for a very strong neighborhood. But also, it reaches every aspect of what our community orientation.
So your relationship was much more transactional, but from that transaction, which obviously sounded very successful, where do you take your relationship now?
Oh, that's the only project we worked on so far, and it's not because we don't want to. And what I like about Becky is we were looking at another for-sale development in the north side, and we ended up not doing it, but I had approached her about being the lender, and she said, well, on this project, because of the size and location, we would need a personal guarantee from the owners of S&A. Personal guarantees go over real well in my office, as you can imagine. So I appreciated her telling me that up front rather than getting through the whole term sheet and further negotiation and drop a bomb. And that she understood that. She knew that would be a sticking point for us. The other thing I'd like to mention is the URA. I thought I saw Jessica in here earlier. The Urban Redevelopment Authority, while Dollar did a great job and we did a great job, this really was a project triggered by the URA. They put a lot of money into the development, acquiring the properties, clearing the properties, working with us on the design, and they respect Dollar Bank and Becky as much as anybody else, and they were highly receptive when I said we were going to work with them on the next phase.
I just want to add the reason I understand the soft financing. I saw Dave Serafini walk in, and he was when he was with the URA, that was the first city project I did, and he navigated me through the acronyms for several years. So, David.
How big of an influence, from your standpoint, are when you look at a deal like this, are the CRA requirements that the bank is trying to address through obviously doing lending and investment?
It plays an important role. We were it was like gravy. It was on top of it because again, I like the strength of the deal because of the developer, because of the location, and then with the mixed income, it was very good to have a CRA aspect of it. We were glad to have that.
Anything else in terms of the keys to successful relationships that you want to offer to the audience?
I think we have communication up there. I think not overreacting to something happening that's not good. At one point during the development, we ran into a water line that was just pouring water into the pipe into our foundation hole. And no one knew where the water was coming from. The water authority, who you would assume would own that water line, said, oh, that's not our water line, that's somebody else's, even though there was no other water authority in Pittsburgh. And Becky didn't, I said to Becky, I said, we're running a little problem. We have a water line that no one's claiming. It's a mysterious spring out there. And she said, okay, just let me know how it works out. And there was no overreaction. Oh my God, you're going to be a month behind construction, or do you have the money for interest? And it's knowing that usually what looks bad 24 hours, 48 hours later usually gets resolved.
Very good. Thank you, Andy and Becky. We're going to move on to our last partnership. Relationship is with Wells Fargo and Clarify. And Molly, this partnership grew out of a strategic outreach that Wells Fargo was conducting. Can you give us a little?
Yeah, sure. So foreclosures have been a very, very big issue over the last several years, as you all know. And it's an example of an issue that grew very quickly, and it took several years to kind of normalize. We're now starting to see pockets in the U.S. where it is pre-recession levels and that sort of thing. We're also seeing issues in pockets in the Northeast specifically, and in Florida where we still have a lot of work to do. Wells Fargo is super big in the space of home mortgage and lending. In fact, we originate 1 out of every 4 loans, and we service 1 out of every 6 in the country. And so when you start to see a trend like foreclosure really start to increase very quickly, you pay attention to it, and you do a lot to help eradicate that issue. So we actually, our servicing team that handled a lot of our loss mitigation efforts grew from a couple of thousand to over 10,000 in a very short period of time. And we really had to look at not only increasing our staff, but how we're interacting with our customers, how we're reaching our customers, and what partners are we working with, how are our customers coming to us. That started out, we started doing direct outreach to our customers, and we started having big foreclosure prevention events. In 2009, we started these, and they were very big Wells Fargo branded. We gave the homeowner an opportunity to meet directly with an underwriter and talk through their situation and try to find a solution. And as we started to develop this approach, we started inviting nonprofits to come as well, because we are very transactionally focused with the customer, and we found that they were dealing with maybe second mortgages, or their mortgage wasn't the only thing they were behind on, or there were some other supports that they could utilize in the community that would really help them be successful financially. So we originally started working with Clarify on some of these bigger events. It wasn't too intensive. They came and they offered their things, and we told our customers they were there and that sort of thing. And then about 2 years ago, we started this really big comprehensive effort. And it was literally myself and my 9 other colleagues across the country. We were calling all 2,000 plus HUD-approved nonprofit housing counseling agencies, cold calling most of them. Some of them we had relationships with, some we didn't. And we were saying, hey, my name is Molly Fukin from Wells Fargo. Let's talk about your foreclosure prevention program. How are you reaching customers? How can we help you? We'd really like to, help you manage your foreclosure prevention pipeline of customers. And it was a completely, it was a huge project, and it was very interesting because we were received in about as many different ways as there were organizations out there. Obviously, lenders don't typically reach out to nonprofits in this way and really start to, try to drive strategies for solving a problem. And so Clarify actually was one of those cold calls that we make, and we'd done some work with them on kind of a policy level with the executive team, but as far as counseling, we hadn't really done a whole lot. And so we cold called, and one thing led to another. They were really responsive. We started having a lot of great conversations. And as foreclosure started to, our numbers started to decrease, and those really big branded Wells Fargo events were not the strategy that we needed to pursue anymore, we started having a lot of really great conversations with organizations like Clarify around how can we partner individually, so it's Wells Fargo and Clarify, co-branded events, smaller and more close to the communities, to really reach the customers that are having the problems with maintaining their homes. And so that was one thing. That was actually how Will and I first met, was in the midst of this 3-day, 3-state very targeted foreclosure prevention event in Clarify offices. And we've been able to do a lot of other things since then. Recently, there were a lot of casino closings in Atlantic City. And we have a very big customer base there, not just with home mortgage, but with banking as well. And we had a very big effort for about a week. We had this big truck that came out. It was called a mobile response unit. And on that truck, it was kind of like a tour bus, only semi-size. And we had little offices inside this big semi. And we had Wells Fargo representatives from the bank. We also had people to help with foreclosure prevention and other services. But then we also had nonprofits on board like Clarify who talked about their services as well. And so we were able to invite community partners and bring homeowners and families that were affected by these casino closings to a lot of resources in their community.
Yeah, so sort of to give the same story from the Clarify perspective, like Molly said, I jumped in about just after that sort of cold calling effort had happened, and I'll sort of start into what made the relationship successful. And I think really early on, it's easy when you're a housing advocate, when you get a call like this, to think that it's not genuine. It's PR motivated. You think about we do foreclosure prevention counseling. We also do home purchase counseling, and we have a lot of relationship with lenders around the home purchase space. And the alignment there is much easier to see. We have people who want to borrow to buy a house. You have money to lend for home buying. The alignment's really clear. In the foreclosure space, it's not quite as clear. Like, we have homeowners who are trying to avoid foreclosure, and your name is the name on the foreclosure complaint that they received. And so you can almost start to see yourself at odds until you start to think about, now they do these big home ownership events where they bring homeowners in to try to prevent foreclosure. And so you start to see like an alignment of business interests where, it doesn't benefit the bank at all to have a big foreclosure docket. It doesn't benefit our homeowners at all to be in foreclosure. And so once you can see that alignment is why I think this relationship really took off in the beginning. Molly talked about the 3-day event that we did. I think it wasn't 6 months after that. We were doing another small event that was Clarify and Wells Fargo co-branded. She talked about the Atlantic County event. We have another one coming up in Atlantic County. It's a very robust, growing, and active relationship. And I think that that's because both sides are very aware of how this is a mutually beneficial thing. It's a very relationally focused thing. It's not a transactionally focused thing. You have a lot of conversations with a lot of servicers and industry folks where you almost feel like you're getting a term sheet as you're discussing, what's going to be done and how it's going to help borrowers. And my conversations with Molly or any of the other folks at the team at Wells Fargo, that's not the question. The question is, what are homeowners facing in the community? What are their problems? And they want to hear about it even if it's not something that Wells Fargo can do anything about. And they get very creative about being able to do something about it. So it's very, like I said, relationally focused. It's not sitting down with, well, we can do X, Y, Z, well, we need A, B, and D. It's not that term sheet transactional sort of approach.
So Molly, when you were reflecting on what makes the relationship work, you talked about being open to different ways, partnership in different ways as the market changed. Can you give us a little more detail on that?
Yeah, so I think Clarify was one of the first, they were the first and I think only agency that we approached with this particular co-branded smaller event, doing a 3-day, 3-state extravaganza, shall we say. And we were able to help just under 100 customers in a 3-day period meet with an underwriter to try and avoid foreclosure in New Jersey, Delaware, and Pennsylvania. And that was a really, really huge success when we came to them and say, hey, we want to partner, let's co-brand it. By the way, let's do it 3 days and in your office and all these kind of things. They were really open to it, and they said, yeah, that sounds like a great idea. We want to prevent foreclosure as well. The Atlantic City piece was another one where this was our first time sending out this big semi that we have to really what we do with it is disaster management, but then also if there are casino closings or there are some sort of a job loss that's going to really affect a community. We're just now starting to experiment with this model, and so Clarify was one of the first partners that we called as well.
So, Will, what would you recommend to the audience as far as the keys to creating a successful relationship then?
Yeah, so I have up here, I think I'd put on the slide, putting your best foot forward. And by that, I want to focus on like two things. One is doing your homework. As refreshing as it was that in our meetings with Wells Fargo and in putting together these events, it didn't feel transactional. In order for an agency to be able to approach it with the same sort of genuineness and to not approach it from a transactional point of view, you really have to know the partner that you're working with. You have to know where their pressure points are and what they're looking for out of the engagement. In order for things to be relational, you have to know the other party involved. And so, doing your homework ahead of time, understanding, this partner as opposed to other partners like it. And the other thing that I think is important to focus on is when we talk about putting your best foot forward, it's your foot. Whatever your agency is, whatever their mission is, whatever drives them, that has to be part of the relationship. If it's something where it just looks like a great opportunity and you're sort of changing like what your agency does, where your area of expertise is, I don't think it would have hit as well. I don't think we would have driven 100 homeowners through a 3-day process. I think the numbers off of that were around 20 homes that were decisioned to avoid foreclosure during those 3 days, which are just incredible numbers in the foreclosure prevention space. And so I don't think we would have seen that if we didn't have the expertise in foreclosure prevention to bring to the table. And so it's putting your best foot forward, doing your homework, and making sure you're being who you are.
And Molly, did you have any recommendations as far as keys to successes?
Yeah, I think building off of what Will said, defining the goals and building off of those is really a very significant key. Sometimes we'll have nonprofits approach us with something that isn't in line with our business goals. It doesn't mean it's not a worthy project. It doesn't mean that it's not something that, we would love to support, but we're spending a lot of energy doing something or talking about something that probably won't pan out. And so really finding that common ground is very, very important. The feedback and communication process is also vital. Clarify and other nonprofits like Clarify have really been generous with us in helping us understand the market. And if something doesn't work and we're kind of confused or puzzled by it, they'll tell us why, and they'll do it in a really honest way. But it also helps build the relationship. So that's something that's very important. And then the quality and dependability of the nonprofit. I know that's been mentioned a couple of times as far as track record and all that kind of stuff, but then also execution when we are doing the events. Are you on time? Are your counselors having, or are your staff members having, really good conversations with the customers, and all those kinds of things are all keys for success.
Thank you. Thank you, Molly and Will. So that concludes our discussion, and we hope that these 3 different examples of partnership involving local financial institutions have provided you all with some ideas as how you can make your relationship with your bank more effective, more productive. I think one of the underlying themes that you've heard across all 3 examples, and there were a couple, is that while financial institutions are very interested in supporting your individual transactions, your housing projects, your community activities, they're even more interested in building longer-term relationships. And that relationship building, while it may start out transactional, it really is a process. So my concluding advice is that when you go home to your communities, you go give your banker a big hug, all right? Just go in there, grab him, give him a hug, all right? Love your banker. So with that, I'm going to open the discussion up to questions from the audience. Again, a reminder to please use the microphone provided. And for those of you on the webcast, you can ask your questions by using the chat feature. Questions? Yes. Yes, sir. Do we have a microphone?
Thank you. Malik Jordan with the Water Group, for-profit developer, headquartered out of Westerville, Ohio. We had one project in Baltimore where we are actually doing home ownership, and I had 2 banks. And part of the stick on where we were sort of stuck at was around the down payment percentage. We got them, they wanted 3.5%. We were able to get them down to 1.7% of source funds. So it was a negotiation process to sort of make the deal work for all parties. So the general question is, how much flexibility have you all from the banking side been able to sort of exhort on, your with your board members or whoever is in the decision-making departments as far as in relaxing some of the regulations, whether it be credit score or percentage of down payment funds required?
When you're asking for down payment, was this for a single-family home or was this a single-family home? I don't deal single-family, so that's going to be you.
Oh, it's me, huh? Well, I can speak in general terms. I'm not on our origination staff, but a huge part of our portfolio is Fannie, Freddie, and HUD. And we have a lot of investors that we work with, and those are the ones that set the rules as far as down payment assistance, credit score, that kind of stuff. Sometimes there's an overlay for Wells Fargo and other banks. I'm sure PNC probably has their own set of overlays, but it isn't a lot. Once in a while, we'll have a smaller, Wells Fargo specific program that may have a little bit of leeway, but some of that's coming from us a little bit, but a lot of it's coming from the investor setting the guidelines.
Any other questions? You were supposed to be marking your questions down and saving them for now. See, okay. Let me ask a question. Generally, we talked about keys to success, but what recommendations would you make to community organizations that are trying to, promote themselves to the banking institution? We talked about the experience and the track record, but what else would you recommend, particularly to maybe smaller agencies that are trying to develop that relationship?
Yeah, I'd say find your path and do it well, and continue to improve on that path and continue to do it well. And if you stick to your mission, and if you're focused in that way, this is just good governance for a nonprofit. And what was that, Dave? Strengthening the balance sheet. Well, with that, from staying to your mission, you're going to strengthen the balance sheet. But it may not come all the time that quickly. We certainly want to see financially that you're viable. But I'm saying, if the advice to me is if you stay to what your mission is and you don't try to sort of say, look, I'm going to go off in 52 different directions because that's what my community needs. But if you can stay focused, all these other pieces will come together. And I think that'll draw the attention of the bank. And then I think the balance sheet will come eventually.
If I could add, I think one thing bankers don't like is surprises. And I think if you have a problem in the project or you have a weakness, then whether you're a community organization or developer, be open and honest. And I can't say I'm perfect about it, but it's better. They don't want to hear that there's a major environmental problem on a construction project that you didn't tell them, because then they have to go back to their boss and repeat it. So you don't want to ever embarrass them. You want to make sure you're open and honest and tell them there's flaws here. There's flaws in our organization or there's flaws in the deal.
Anybody else? Good. Okay, well, that's all we have for today. So thank you all for attending, and please give our panel a round of applause. And thank you to our remote audience for watching the webcast and for participating in the panel. Thank you.
I'm gonna take a little time to look around me. I've got nowhere left to hide. It looks like love is finally